We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Craig Hemke from the TF Metals Report. How are you today, Craig?
Tom, I'm fine, thank you. It's a pleasure. Nice to see you.
Nice to see you too, and glad to see you're on the uptick from having the COVID.
Yeah, me too.
So your macrocast report that you wrote at the beginning of 2020 was quite accurate in terms of predicting the prices of the metals. But as we've seen, the last year was, so unpredictable and turbulent. So what are some of the biggest macro factors that you're keeping an eye on for the coming year?
Well, it's kind of an extension of last year and the year before, actually, Tom. Mm-hmm. We were kind of stuck in the mud back in 17 and 18 as part of we were in that trading range for 5 or 6 years where we couldn't get above 1350, or so we get up to 1360 and then go right back down. But what caught my eye, and now you can look back, with hindsight and see it pretty clearly, was this impending change of Fed policy in late 2018, where, they had kind of crafted this illusion. Even Yellen, who now is going to be Treasury Secretary, was out there saying, gosh, watching our balance sheet contract and be like watching the grass grow, and we're going back to normal, whatever that was. And everybody kind of bought it, at least the, broader markets did. Mm-hmm. And this notion that rates were going to go back to 4 or 5% on the 10-year, and the Fed's balance sheet was going to go back to pre-financial crisis levels. And everybody just kind of swallowed that for 5 or 6 years. Till finally, November, December of 18, 10-year note got up to about 3.25, and man, everything just seized up. Mm-hmm. And the stock market crashed in December of 18. And I thought, okay, now they're going to have to reverse course, which they finally did in June of 19. But beginning in January of 19, I wrote my annual little forecast, which is always kind of tricky business. But I wrote then that I thought that 19 was going to be the year that we'd break out. And you could look at the chart and go, okay, well, if we did break out, would be a logical, resistance point. Mm-hmm. And you could look and see, well, okay, back in 11 through 13, before we broke down, about 15, 20 had been pretty considerable support for a long time. So I thought, well, okay, that'd probably be a good target for 2019. That's exactly where we finished. So we kind of overshot it in the summertime before pulling back. So knowing that those easing conditions would continue, and not having an idea about COVID and everything that came with it, but knowing that those conditions would continue, I thought, well, why wouldn't we continue in 2020? And I thought, okay, you look at the chart, again, there are a lot of weekly resistance and monthly resistance up around 1800 or just beyond there. And I thought, okay, well, that seems like a reasonable target. Mm-hmm. And of course, we well overshot that, but finished year around 19. And again, knowing that, the Fed has done everything they can to tell us that they're not going to do jack, right? Mm-hmm. The market, everybody just desperate in the 24-hour news cycle to have them say something otherwise. But they've been hanging in there, saying, no, we're not raising rates till at least 2023. Mm-hmm. And we're going to keep buying bonds at this rate, all through this year and into next. So no real change in Fed policy. And I think, again, what will bring some changes this year to Fed policy, some of the things I think they're going to do, should provide another good rally this year. So that's kind of how I came up with the previous forecast and how I came up with this one.
Mm-hmm. So looking at this one, what is the main driver, as you see it, of the gold price for this coming year? Could we see the Fed come in and, really try to exert some type of yield curve control, and in which ways could they, really try to do that? Because there's maybe a couple, like, let's say, covert or overt ones that they could try and do that with, right?
Yeah. And I think that's what's coming, Tom. It'll come in stages. One of them, as we record this, we wait for the Fed meeting this week and see what they announce. Mm-hmm. If you go back to last year, as we were in the summertime of last year, there began these series of trial balloons, some of them being released like late Fridays on Bloomberg and the Wall Street Journal, of an impending Fed policy change. And just like in politics, you get these trial balloons put out there, and if nobody really objects, then the politicians go, well, I guess nobody really cares. So we might as well go ahead and do this. Mm-hmm. And that's what the Fed was doing. And they were warning that they were going to change their inflation targeting method, because in the past, they had this, once we got to 2% inflation, it was time to hike rates. Mm-hmm. And they didn't want anybody thinking that, right? Because they know they're going to keep rates low for a long time, because this COVID stuff, the damage has been done, and it's not, like some sharp V-shaped recovery. So they don't want anybody thinking that as soon as we get to 2% inflation, that they're going to hike rates. Mm-hmm. So they wanted to announce that they were going to change that policy, and they did. Powell announced that at the virtual Jackson Hole meeting in late August. Well, the second leg of that stool, that policy change that was included in all those trial balloons, was this notion of yield curve control, mm-hmm. Meaning that the Fed, kind of like, how people talk about the Fed put in the stock market, the Fed always had your back. Mm-hmm. And even if they didn't, just the notion that they did was a lot of times to get the market to turn around and go higher. And that's what the Fed prefers to do. They prefer to just, jawbone, mm-hmm. Rather than actually have to do anything. But we know they don't want higher interest rates. They can handle it up to a certain level. The ones that they don't directly control, like 10-year notes and things like that. And we've seen that rate go higher. That's the biggest thing that's been holding gold back since August. The 10-year note got down to 55 or 60 basis points. And here a couple of weeks ago, it was up to like 115. So we know that they don't, maybe they're okay with 115 or 1, but probably not a lot higher. It also came up, one of the FOMCs last summer, like maybe in June, that the Fed even admitted that they had, during the FOMC meeting, they'd received presentations from Fed researchers on the history of using yield curve control in the past. And they have. They did this coming out of World War II when debt to GDP ratios got to where they currently are, mm-hmm. or even, we're even higher now. And what the Fed did then to try to inflate away that debt to GDP ratio was they instituted yield curve control, which drove real returns sharply negative, okay? In bringing this all back together, that's what they warned us they're going to do next. That once they do this, whether de facto or actually have to actually state the policy that we're not going to allow it above a certain level, mm-hmm. and then inflation comes along at some point, we got to bank on that too, you're going to get real interest rates, inflation-adjusted interest rates making even lower lows, below the negative maybe 1% they are now, to maybe -2, or maybe even -3. Anybody that studies gold likely knows that the level of real interest rates is about the most direct correlation, long-term correlation that gold prices have. The last time we had significantly negative real interest rates was back in the late 1970s. And a lot of folks recall what happened to the gold price then. So anyway, real long answer for you, Tom, just trying to make sure everybody's kind of following along. Anything the Fed does that locks in negative real interest rates is going to drive the gold price higher. And I think those are the steps they'll take this year. And that's going to be the driver, to higher gold prices.
Absolutely. So we're talking here on Tuesday, the 26th, the morning of Tuesday, the 26th. And, as we discussed, we're waiting for the FOMC meeting, but also the today's expiration of the COMEX options. So how could that affect the gold price as well?
It always seems to be a hindrance, having options expire. Because a lot of, the writers of the options, the market makers are often, maybe bank desks and the like. And if you study it long-term like I have, it seems to be there's kind of some nefarious intent around option expiration to try to minimize the financial damage to the writer of that option in the first place, because they pay out in cash at expiration. So the more you can move out of the money or not finish in the money, the less painful it is to the writer of the option. So it doesn't always work out this way, but a lot of times you can look at the open interest for calls and puts and kind of find a sweet spot that maybe is the least financially painful for the writers of the options. And sure as heck, for this current February gold contract, I went back and looked over a week ago, and it appeared to be somewhere, the price looked to be somewhere around 1850 to maybe 1875 at the top end was that kind of sweet spot. And lo and behold, here we are. It's, long-term, big deal. But it's just something that as a market observer, or if you're an aggressive trader, you might be mindful of every time that front month goes off the board and the options go with it. Probably more significant is having the contract itself go off the board. And because a lot of times, you've got hedge funds, institutions, managed money, they're long. They're not often short, right? You get into the COT report, you'll see managed money is generally net long. And again, in this instance, gold contracts. And a lot of times they're in that front month. The February contract has been the front month since, 1st of December. And that's where all the most of the volume and most of the trading is. Well, that contract's going off the board. And if you want to continue to own it come Friday, you've got to have 100% margin in your account showing you intend to take delivery or stand for delivery. Well, that's not what they want. They just want exposure to the price. And so they're going to sell their long positions, which again, that's primarily what they have, and then roll them over into April or maybe June to continue that exposure. Well, if you're net, as a group, you're net long, whatever they are, 80,000 contracts, that's a lot of selling pressure, right? Net selling pressure.
Right.
And if the price is declining at the time, if the picture's been painted to, have sentiment not so good, think of yourself as that hedge fund manager, and you've got, 500 February gold contracts. And that's your position because you like the macros, all this other kind of stuff. But in this particular moment in time, you've got to take 500 February golds off. You're looking at your screen, you're like, all right, I'll liquidate those 500. That's selling pressure. But rather than buy 500 right away in April, maybe I'll just buy 250. Because maybe I can buy the other 250, $20 lower. And in a real simple explanation, you can see where that's 250 contracts of net selling pressure, right? And so a lot of times into that expiration, where this contract is going off the board and all these rolls are taking place, you get net selling pressure, which means lower prices. So that may continue into midweek as well. But anyway, I'm sorry for the lengthy explanation, but there are trading gold futures is a lot more complicated than just a dot on a screen and counting waves and, that some people do. There's a lot that goes in, into how that price is discovered.
So as you're kind of saying, if you're in this trade for the long term, how are you trying to give your audience some perspective to try and not get bucked off this gold bull, as you were talking about? What are some of the biggest factors to keep in mind when we see, Mondays when gold mysteriously opens and immediately gets slammed by $40 to $50 an ounce?
Yeah. And I got to tell you, to that end, that's why I trade very little anymore. Because, as with any market, so many times, you have to almost be contrarian or counterintuitive if you're going to profit. The adage I've had since I started TF Metals Report 10 years ago was, if you're trading, you almost have to always be ready to sell some when things look the best. Yeah. You think back to 4th or 5th of January, just 3 weeks ago, we're breaking out. There's a pretty clear technical pattern of a bull flag on the chart. We're above the 50-day move, everything. Woo! And that was a day you should have sold some rather than buy more. And the same thing is true on the other end. When things just look awful, like the end of November, oh my God, and everybody's coming out, all the perma bears are coming out of the woods to talk about gold going to 1,200 and all this stuff. That's the time you got to buy some. Got to just hold your nose, go on faith that you're seeing the big picture right and buy some. It's because of that, a lot of what I've done over especially the last 4 or 5 years, is transition more into big picture stuff. And again, trying to help people stay on that goal, because, that metaphor is a good one. If you're going to go to the bull riding championship, who wins? I mean, you got to stay on that thing the whole time to the bell if you're going to win. If it throws you off, okay, you did well for a while, but you didn't make it all. You didn't profit all the way to the end. And that's kind of what bull markets are like in the precious metals too. And so what I try to do is really keep reminding people of that big picture, because again, what the debt in U.S. debt's going through 30 trillion, the deficit this year alone might be 4 trillion, and the Fed is monetizing almost all of it. And they're going to implement in stages, as we kind of discussed, this idea of yield curve control, which is going to institutionalize negative real rates. We've got negative nominal rates now to the tune of $18 trillion in debt around the globe. I mean, all of these extraordinarily positive fundamental reasons for owning physical metal. And so you got to, like I said, you got to keep your eye on that big picture a lot of time. Otherwise, it can get kind of disheartening.
Absolutely. So as we're talking about the big picture, Craig, why does the silver chart look so much better than the gold chart right now?
Yeah, isn't that funny? It does. And by extension, things like the junior silver miners look a lot better than the junior gold miners.
And they've also held up a little bit better, right?
Yeah. Well, and silver's kind of caught in the middle in that there's people, I would assume, I don't know, I don't want to speak for you, Tom, but there's people like me, people on my site that still see silver as a monetary metal, and an investment. And maybe one day, who knows, it becomes it has a monetary history longer than gold. So you've got it, a lot of people see it that way, but not, I shouldn't say a lot, because the majority of the people see it as an industrial commodity, right? Like copper, a conductor of electricity, great in solar panels, and the like. And so it's kind of caught in the middle. You got gold, which is sitting here going sideways as a monetary metal, as interest rates have risen, and the dollar's doing its thing and nobody knows what's going to happen next. But then you've got commodities in general that are doing really well. I mean, what's copper at 8-year highs? A lot of these base metals, zinc and aluminum and lead, and the like, they're all doing great. And so silver's kind of splitting the difference. What's interesting, a lot of investment banks have come out with $40 price. I mean, it used to be, excuse me as I itch my nose, it used to be the realm of, the crazy, silver bug, gold pumper, that they're always coming out with these higher price for it. And now you got, I guess we just call them mainstream sell side research, calling for $40 and $50 silver just because of the dynamics, supply demand dynamics, and commodity price inflation, a weakening dollar, general commodities bull market, that kind of thing. So I think that's the divergence for now that's making the silver chart look so much better. It actually already has broken out of what looks to be what we call a bull flag from a technical analysis standpoint. And boy, I tell you, man, what is wrong with my nose? I tell you, if I shouldn't say if, I think when we get a toe hold up above the highs from 3 weeks ago, up above 28, and probably jump pretty quickly to those highs from last August, up near 30. From there, could easily get a run into the middle 30s. And here I am, Mr. Metals guy, actually considered conservative by a lot of folks when I say maybe 38. This year, but that would be, that's a pretty good, almost 50% run again this year. So there's nothing conservative about that. And if we get $38 silver, man, there's some of those silver miners are going to be rolling the cash.
So exactly as you're saying, if we get, let's say a $38 silver price, and we really see some interest in those miners, could that drive a surge of institutional interest and cash into this year?
Yeah, see, that's the thing. And this is part of why I'm just big picture most of the time. And you want to make sure you're in the right positions, and most of my holdings are physical metal anyway. But if you want to make some fiat, you can, really have some fun with the miners because of that leverage. And what we're all waiting for, I kind of thought we'd see it last year, but, the way everybody just wants to trade, a handful of stocks, it's just like there's really no institutional interest yet on a massive free cash flow generating, great P ratio, increasing dividend sector like the miners. It's just like, who cares about that? I mean, that would have been a huge story 20 years ago, right? Now it's like, no, just buy me some Tesla. I don't care.
Go with the crowd.
Right. And so we're still bumping along. Global asset allocation to all precious metal investments, whether it's the shares, ETFs, the unallocated accounts, the futures contracts, is still only like 0.5% institutionally. The long-term average, historical average going back 4 decades is more like 1.5 to 2%. So we don't even have to go back to that mean. let's just say we go to 1%, we get some interest. It's such a small, puny little sector. I mean, there's only a handful of stocks in the first place that mine gold. And then as Rick Rule, I just talked to him last week, he said, within that handful, there's only a handful that you really want to own. Mm-hmm. And so there's still going to be that potential at any time for this flood, and it's not even a flood, but an uptick that's going to appear to be a flood of institutional cash chasing a pretty limited, finite supply of shares or, ETFs or whatever. That can have a pretty dramatic impact. And I just don't want to miss that. I bring you back like to it was January 19th of 2016 when the Hui index broke through 100 and went down to 99.19. And everybody was like, that's it. And all these people were saying that it was going to 60, and stuff like that. And then lo and behold, it went to 280 or 290 by August. Well, if you weren't already long shortly after 99.19, you were chasing, it might've gone to 150 and then you're like, God, it's already up 50%. I got to wait for a pullback. And then it goes up another, 30%, it's at 200. You're like, geez, okay, I'll start to nibble, waiting for more of a pullback. And then finally, maybe it's 250 and everybody jumps in and then they pull the rug out from under you.
Yeah.
And so the key really, I think if you get that big picture right and you're in before the proverbial train leaves the station, that's how you're going to win.
So Greg, in reading a couple of your articles, to prepare for today, you were saying that the Fed and other major central banks could actually benefit from a higher gold price going forward. How would that work? The simplest thing to, I guess, frame it is a higher gold price leads to a perception of inflationary expectations. The thing about the higher gold price is it leads to inflationary expectations. And that's what the Fed and the other central banks are trying to foster. That's what Powell even said in his Jackson Hole speech. He was alluding to Japan, but he said, what we most have to avoid is this feedback loop of deflation leading to deflationary expectations, leading to more deflation, leading to greater deflationary expectations. Now, the misconception, whatever, of gold is that it's an inflation hedge. That's been proven not be correct. Gold does not just simply trade with inflation. What gold trades with is inflation relative to interest rates, these real interest rates. Okay, if you make 1% of your treasury note, but inflation is 3%, your real return is you're losing 2% a year. It's a guaranteed loser. That makes gold look pretty damn attractive. It doesn't pay a dividend, but it beats the pants off a negative 2%, right? Who cares about what the interest is? You get some upside potential, total return. So anyway, the Fed maybe in the past has maybe not been a fan of higher gold prices because it's been looked at as being competition to the dollar and the other fiat currency. And if gold's going up, it reflects a lack of confidence in the dollar. But I think the Fed now, and again, Powell has stated as much, is more concerned about deflation. And that's been what they've really been fighting since November of 2018. And so that's what has them frightened and concerned. And so they want to spark as many inflationary indicators as they can. And so, I don't think the Fed's in there buying gold futures to try to do it. But I don't think they're going to promote policies that would, make people think they should sell gold instead of buy it. And if you can get a 20% move in gold that plays out over 12 months, that, when people are trying to, and I mean people like institutional money managers, where the real rubber meets the road. They look around and see gold prices rising 20% year over year. They're going to take that into consideration when they try to decide if, we should be expecting inflation or deflation. Does that make sense? That kind of pile that together.
That's why, like I said, I don't think the Fed's out there. They're not yet out there ready to say, we want gold to be $10,000 an ounce, because that would,
also signals a lack or a loss of confidence, right?
Right. But I don't think they're necessary. They wouldn't going up 20% a year, I don't think would bother them either. And you could say that for commodities in general too, because again, they're trying to spark inflation. If you can get rising input costs, you know, like copper and aluminum and zinc and, you know, all the rest, crude oil, that is a component of, you know, what these economists call cost pushed inflation. You get input costs to go up. That maybe gets passed along by the manufacturer and the retailer, right. And that pushes inflation higher. So they're okay with commodity rally as well. And that kind of, again, now we're back to talking about silver.
So as we're talking about, let's say, a loss of confidence in the U.S. dollar, we've seen it start to gain a little bit of traction already this year. How likely do you think this is to continue?
Well, the hard part about this, Tom, is when analysts or media talk about the dollar and the value of the dollar, they're almost invariably talking about the dollar index, right? Well, what's the dollar index? It's just a basket of other similarly depreciating fiat currency, right? I mean, the lion's share of which is a euro. So you can look at it and think, well, the dollar's getting weaker. Well, all that really means is maybe the euro is getting stronger, relatively speaking. And, you know, if the ECB were to take steps that would weaken the euro, well, then that's going to be perceived as a stronger dollar. And so that's kind of the challenge of the current system. You know, they're all kind of, they're free floating against each other, but they're all free floating downward at the same rate, you know? And so,
if you look at it comparatively to something like gold, right?
Right, exactly. And so I don't know. Again, it is for the Fed, if they look at it selfishly and they want to selfishly inspire inflation, you know, and maybe growth by having a weaker currency and all that kind of stuff, I think they're okay with a weaker dollar, not, you know, a plunging dollar, you know, that goes to 80 in a week or two, but one that maybe goes to 85 or 84 or something over the course of this year. I think they'd be perfectly fine with that.
So, Greg, you wrote in this year's Macrocast about the great Keynesian experiment barreling towards its inevitable conclusion. So, what do you think that conclusion looks like? Will we see the implementation of something like a central bank digital currency? And could that pose a serious threat to other digital currencies like Bitcoin?
That's, you know what, that kind of stuff probably not entirely in my wheelhouse. And some kind of digital currency wouldn't surprise me, just to allow the central banks to, I guess the policy is loosely called helicopter money. You know, if it allows them to just increase the money supply and get it out to people fast, you know, in their attempt to constantly spark enough inflation to keep the plates spinning, that could be part of their end game, or at least process in moving toward the end game. Yeah, my site, which has now been around for more than 10 years, has always had the tagline that we are preparing for the end of the great Keynesian experiment. Keynes being the Depressionary economist that so many, you know, now Nobel laureates base everything off of, saying, you know, that this debt-based system, you just keep increasing the debt and you get growth at the same time and everybody benefits and blah, blah, blah. But we're clearly at the end where a dollar of new debt does not promote a dollar of new growth. And that debt begins to grow exponentially because you need to print more and more cash just to service all of the existing debt, right? And this is all part of why the Fed can't allow higher interest rates with, again, yield curve control, because you get to where if you're going to try to service all of the existing debt at 4, 5, 6% interest rates, it just sucks up so much cash. That in its own right is deflationary, right? So they've got to keep interest rates down. Market forces may demand higher interest rates, right? Well, why do I want a negative 2% guaranteed treasury? Right? I'm not buying treasuries until they, you know, the nominal return is at least above the inflation rate. So you're tempted to sell your treasuries, which then lower treasury prices means higher interest rates. But we can't have that. I mean, what's the line item in the US? The line item of interest on the national debt annually, you know, is already $500 billion. And that's at barely north of 1% for an average interest rate across the whole spectrum. So what if that goes to 2? What, is it going to be $1 trillion? You know, so the whole thing just begins to just rapidly spin. And it's not just at the national public level, it's the public level states and cities, people with their mortgages, people with their credit cards. Nobody can afford higher interest rates.
And that seems to be what's really different this time about,
right,
let's say, if they actually get to spark the inflation that they're currently quote unquote targeting, right? Is that they can't, if that gets out of control, they can't necessarily raise interest rates to be able to control that.
Right. Like Paul Volcker did and ended that previous gold bull market in 1980. And so you get it back to the end of the great Keynesian experiment. Yeah, that's where we're headed eventually. And I don't know what that number is, but eventually the total amount of global debt just becomes unserviceable without this just collapse. And so what does that look like? I think that was what your question was. That's the challenging part, because it's not like we can say, well, the last time this happened a couple of years ago, you know?
Yeah.
What I've always kind of hung my hat on, and why I own so much physical gold as a ship in this storm, is the pendulum kind of swings back and forth, right? And my friend, guy by the name of Willem Middelkoop, wrote a book in about 2013 called The Big Reset that was coming. And in the back of that book, and he's got this for free now, anybody can read it, is an appendix. It's like about 10 pages long of all the fiat currencies over the millennia that eventually just expired, just gone worthless in time because they were just printed so freely to, you think of Weimar Germany, or present day Venezuela, things like that. And what invariably happens is you start with a currency that's anchored to some kind of something, gold, or something. It has an anchor to it to have confidence in it, so people want to hold it and people want to transact in it and all that kind of stuff. But eventually, your society and your politicians and everybody else they start, devaluing that currency by printing more and more, but you lose the anchor, and your pendulum, which started over here fully back, swings all the way over here to where it's just nothing. And there's no confidence at all. And finally, what usually happens is you go swinging all the way back. And you start over with some kind of anchor, because you've got to, because nobody has any confidence in it anymore. So we got to apply some kind of anchor to it again, whether that's gold next time or a basket of gold with, who knows? But I suspect that's what's going to happen. And that's why I think it's, that metal is a vessel to eventually see you through all of this.
Excellent, Craig. As we wrap up, is there anything else you'd like to kind of touch on?
Well, for people that, are viewing this with the hindsight of what the Fed did announce, my forecast this year of another maybe 20% at some point in gold prices, whether we finish there or not, we'll see. But I think again, for these macro conditions are going to continue. So I would expect gold and silver prices to continue, at least at an average pace. But the driver of that will be these more negative real yields. And what's going to drive that is some type of lid, whether formalized or not, on the nominal yields, the 1.1% 10-year treasury or whatever. The Fed will do this. They warned us since last summer that that's a second leg of this policy of letting inflation run a little hot, but they're going to cap yields. So they're going to do it first. They're going to, they're going to try to jawbone their way out of this first. And so in these headlines that'll come out or will have come out on Wednesday and in Powell's press conference, just look to see if in setting this thing in motion, there isn't a line where, as Steve Leesman reads them off here in the US, a few participants noted that it might be beneficial to extend the maturities that the Fed is purchasing as part of their current long-term large-scale asset purchase program. That's the beginning of that Fed put, saying that instead of just buying T-bills, and real short-term notes that they're doing currently, they're going to start buying more 5 years and 7 years and 10 years. And then the bond market looks at it and goes, well, I don't want to fight the Fed. So maybe that caps yields for now. But then as inflation goes, there's more selling pressure, like what we saw with yields spiking a couple of weeks ago. So maybe that didn't work. So then by the Fed meeting in March, maybe the Fed has to actually come out and say, the Fed will formally now extend, and here's what we're going to be buying, more 10 years and 20 years, because we don't want longer rates to go up. And then if that doesn't work to keep a lid on nominal rates, then maybe by the summertime, they got to come out and say, anytime we get above whatever level, 1.25, 1, whatever on the 10-year, the Fed stands ready to buy treasuries to buy it back down. And then at that point, you'd be an idiot to sell. I mean, anytime you got up near 1, here'd come the hedge funds and everybody else driving rates back down for them.
Yeah.
They wouldn't even have to ever buy anything. Just the perception that the Fed's going to do this and so then all of a sudden rates never go above 1. The Fed's going to allow inflation to run past 2 to 3. You get negative 2% real returns, which is about twice as negative as they were last August. Gold's going to go up, and silver too. And we start looking at $2,300 gold, man, the shares, at some point those floodgates are going to open. So that's kind of how all this comes together. First thing people to watch for this week is to see if there's any wording change, however slight, alluding to that policy. Let's see what they say.
Excellent. All right, Craig. Well, of course, our listeners can find more about your site and your information at tfmetalsreport.com and, of course, at tfmetals on Twitter. Anywhere else?
That's the place. Yeah, you can follow me on Twitter. That's a fun place to kind of exchange ideas. But yeah, just tfmetalsreport.com is the site. I write a report every morning, kind of summarizing what's going on. I record a podcast every afternoon. I'm kind of, what I kind of say for people is I'm kind of your eyes and ears, so you can go about your business, doing all the other important stuff. Then you just check the podcast at the end of the day, and I'll tell you if anything significant has happened that you need to be aware of. For that, you pay 50 cents a day. It's $15 a month. It's not like, I never wanted to price people out. But that helps me keep the lights on, pay my health insurance costs. I can tell you that. So anyway, tfmetalsreport.com is the site.
Excellent. Thanks very much for your time today, Craig.
It's always a pleasure. Hopefully we'll do it again soon.
Absolutely. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.